The payments industry moves fast. The economics behind it move even faster. Welcome to On the Wire, a show about the economics of payments, the institutions moving money, and the infrastructure underneath it all. This episode is produced by Payware using AI voice synthesis, built from primary research, technical documentation, and real market data. No studio, no hosts, just the content, clearly presented. Let's get into it.
So every time you buy a coffee, you are likely paying this completely hidden tax.
Oh, absolutely.
And it's basically funding, someone else's first-class flight to Hawaii, which is wild.
It really is. It is the ultimate phantom cost in our modern economy.
Right. And the craziest part about this whole thing is that neither you, the customer, nor the barista who's swiping your card actually realize it's happening.
No, they have no idea. I mean, take a mid-sized merchant, right? Say a regional furniture store.
Okay.
And let's say they're doing like 10 million euros a year in sales. Business looks great on paper.
Sure, 10 million is a solid year.
Right. But at the end of the year, they sit down, they look at their processing statement, and they realize 100,000 euros has just completely vanished. Just gone. And when they ask where the money went, they basically get this two-word answer: interchange fees.
Interchange fees.
Yeah. It's this massive expense that is completely misunderstood by businesses and, entirely invisible to the consumers who are ultimately funding it.
Yeah. And that hidden tax is exactly what we are dismantling in today's deep dive.
Mm-hmm.
We're looking at the underlying economics, the honestly bizarre history of this, and the rapidly approaching future of card payment costs.
There is a lot to unpack.
There really is. And we're also going to look at some fascinating data today from a report by Payware, which is an account-to-account, or A2A, network.
Yeah, that report is really eye-opening.
So the mission for you, the listener, today is pretty simple. We are going to figure out exactly where this money goes, why the global financial system is, structured this way, and why a massive technological shift is brewing right now that could change how you pay for absolutely everything.
Which, by the way, matters directly to you because, you might think you are immune to these fees.
Yeah, right? You just swipe your card and the price of the shoes is the price of the shoes.
Exactly. But you are indirectly footing this bill every single time you tap a screen.
Because the merchants have to cover it somehow.
Precisely. They have no choice but to bake these enormous payment costs into the retail prices of their goods and services. So, you are paying for it whether you realize it or not.
Okay, so let's unpack this because honestly, I always thought I understood how this worked.
Most people do.
Right. If I use a Visa or a MasterCard, I just assume Visa or MasterCard takes the fee. So what exactly is happening to the money in those 2 seconds after a card gets swiped?
Well, to understand the disruption that's coming to this space, we first have to look at the anatomy of the transaction. And your assumption is incredibly common, but it's actually wrong.
Okay, lay on me.
When you make a purchase, there are primarily two banks talking to each other in the background. First, there is the acquirer.
The acquirer, which is what exactly?
That's the merchant's bank.
Okay, got it.
And second, there is the issuer. That is your bank, the customer's bank.
Okay, so we've got the merchant's bank and the customer's bank. Where exactly does the cart network come in?
So the networks basically act as the communication rail, and they do take a very small slice, which is called an assessment fee.
Okay.
But the vast majority of the total cost, the actual interchange fee, that is a bank-to-bank transfer.
Wait, really?
Yeah. The money is literally interchanging from the merchant's bank directly over to the customer's issuing bank.
Oh, wow.
And, the sheer scale of that fee discrepancy globally is staggering.
Yeah, the data in the sources on this is just wild. If we compare a transaction of, say, 100 euros in Europe versus $100 in the United States, they look like entirely different financial universes.
Well, completely. In Europe, the issuing bank gets a regulated fee of roughly 20 to 30 cents on that 100 euro purchase.
Okay, 20 to 30 cents. Seems reasonable.
But in the U.S., for the exact same digital handshake, the issuing bank takes anywhere from $1.50 to $2.50.
That is the part I just cannot wrap my head around. It feels like a totally backward infrastructure setup.
It does.
It's like driving across a toll bridge, but instead of the toll going to the engineering company that actually built and maintains the bridge, the biggest chunk of your money goes to the mayor of the town you're driving to.
That's a perfect analogy.
But why? Why on earth does the customer's bank, the issuing bank, get the lion's share of the fee?
Basically, because they demand it.
Seriously?
Yeah. When you map out the flow of money, it reveals this fundamental truth about the payment industry. The largest cost burden placed on a merchant has almost nothing to do with the actual technology of moving the money.
Because moving bytes is cheap.
Exactly. Moving digital bytes over a wire is incredibly cheap. The massive fee exists almost entirely just to compensate the issuing bank for participating in the network.
Wait, hold on. Let me stop you there. If moving digital money only costs like fractions of a cent, how do the banks defend charging 3%?
Well, they have their reasons.
They have to have justification, right?
Yeah.
For taking $2.50 out of a $100 purchase just to update a digital ledger?
Right. And they have several historical justifications.
Yeah.
If we look back to the 1960s and 70s when these networks were actually being built, banks laid out 4 main arguments to justify the high fees.
Okay, let's go through them. What's number one?
The very first one they always point to is fraud risk.
Right, covering their bases.
Yeah. The bank argues that they bear the financial risk of a fraudulent transaction. So naturally, they need to charge a premium to cover those inevitable losses.
But the math on that totally falls apart.
It really does.
I mean, when you look at the industry data today, actual fraud losses are microscopic. We are talking about, what, 0.05 to 0.15% of total transaction volume.
Exactly. It's a fraction of a percent.
But the fees in the U.S. are 1.5 to 3%. Like if I go to an insurance company to buy fraud insurance, I'm not going to pay a premium that is 20 times higher than the actual statistical risk of the event happening.
Right. You wouldn't, because it makes zero economic sense.
No sense at all.
The fraud risk is a real phenomenon, yes. But mathematically, it justifies a fee of maybe 0.1%.
Yeah.
Certainly doesn't justify 3%. So, when pressed on that, banks usually pivot to their second argument. Infrastructure.
Ah, the servers.
Exactly. They say, look at these massive authorization systems, the fraud detection centers, the global customer service networks we built. We have to recover those costs.
But aren't those sunk costs from decades ago?
Yes.
I mean, the servers are already humming. The marginal cost to process one additional digital transaction today has to be effectively zero.
It is. It essentially is zero. A really great way to visualize the disconnect here is to look at the cost of maintaining a basic checking account.
Okay.
It costs a bank maybe 2 to 10 euros a year in overhead to maintain a standard digital account for a customer.
Okay, so barely anything.
Right. But if you spend $10,000 a year on a typical U.S. credit card, the interchange fees generated for the bank are between $150 and $300. Yeah. The fee structure is completely untethered from the actual cost of running the digital infrastructure. It basically morphed from a cost recovery mechanism into a massive profit center.
Okay, genuine question here, though. What about credit risk?
Right, the third argument.
Like, if I max out my credit card buying expensive electronics and then I just default on my debt, the bank eats that loss. Doesn't that justify a fee on the merchant's end?
It seems logical at first glance, right?
Right.
They are providing the customer with an unsecured line of credit.
Exactly.
But think about the consumer side of that equation. Don't the banks already charge 15 to 25% APR to cover that exact risk?
Right. If I carry a balance, I'm already paying through the nose for it.
Exactly.
So the merchant shouldn't have to pay for my credit risk, too.
No, they shouldn't.
But okay, where this really breaks my brain is debit cards.
Oh, debit is wild.
Because if I use a debit card, that money is coming directly out of my checking account. The bank isn't loaning me a dime. There's no credit extension, no float, no risk of default at all. So what exactly are they charging a fee for on a debit card?
You've hit on the exact flaw in the logic there. There is literally zero credit risk on a debit transaction. And yet, debit cards still carry interchange fees.
That's just crazy.
Which leaves the banks with their fourth and, frankly, most fiercely defended justification.
Let me guess.
Rewards programs.
Yes.
They claim these high merchant fees are absolutely necessary to fund your cashback, your airline miles, your purchase protection.
Ah, yes. The VIP lounges.
Exactly.
So, wait, let me get this straight. When I feel like a savvy consumer getting 2% cash back on my fancy metal premium card, the merchant is actually paying like a 3% fee on that transaction.
Yep.
And the bank gives me 2%, pockets the remaining 1% as pure profit, and the merchant is forced to raise their store prices for everyone just to survive.
Exactly. And that means even the people paying with cash or a basic debit card are subsidizing your rewards.
That is That is
It's
infuriating.
a very regressive system.
It's essentially a system where merchants are being strong-armed into funding the bank's marketing and customer acquisition budget.
That is the perfect way to describe it. It's a circular logic loop.
Right.
Banks could easily fund rewards out of their other massive revenue streams, account fees, interest income, investment returns. But instead, they just force merchants to subsidize it.
Wow.
So if fraud, infrastructure, credit risk, and rewards don't mathematically justify the sheer size of these fees today, what actually does?
Is it just raw monopoly power?
Exactly. Network effects and market power.
Okay, explain that.
Well, back in the 1970s and 90s, accepting credit cards was a competitive advantage for a merchant. It was just a convenience.
Sure, it brought in more customers.
Right. But as adoption grew, the network effect really took over. More consumers wanted to use cards, so more merchants had to accept them.
Right, a snowball effect.
Exactly. By the 2010s, it shifted from a neat convenience to an absolute non-negotiable lock-in. Today, with over 80% of transactions in developed markets happening on cards, a merchant is effectively trapped.
You really can't run a successful retail business today and put up a sign that says cash only.
You really can't. It is a strict, must-accept environment.
So because the merchant has literally no alternative, the card networks and issuing banks can just charge whatever they want.
Exactly.
They aren't pricing the service based on what it actually costs to provide. They're pricing it entirely on what the market will bear.
Precisely. When a service evolves into essential economic infrastructure and there are no viable technological alternatives, the provider wields massive market power.
So, okay, but if this market power got so wildly out of control, why haven't regulators stepped in? I mean, you would think governments would look at a phantom tax on the entire economy and do something about it.
Well, they actually have. But how they handled it created two totally different payment universes, depending entirely on where you live.
Okay, let's talk about Europe first.
Right. In 2015, the European Union looked at this dynamic and recognized that it was actively harming economic competition.
Because the merchants had zero leverage.
Exactly. Merchants had zero negotiating leverage, and those inflated costs were artificially inflating the price of consumer goods. So Europe brought down the regulatory hammer.
What did they do?
They instituted hard caps. Debit interchange fees were capped at 0.2%. and credit at 0.3%.
And did the banking system collapse?
Not at all. Merchant payment costs plummeted by 60 to 75% almost overnight.
Wow.
And that generated over 1.5 billion euros in retail savings annually.
That's incredible.
Yeah, Europe essentially proved that you can slash these fees down to their actual technological cost without breaking the financial system.
Wait, so if Europe ran the experiment and they proved that capping fees saves billions of dollars for the economy, why hasn't the U.S. done the exact same thing for credit cards? Are American consumers just that addicted to their airline miles, or is the banking lobby in Washington just untouchable?
Honestly, it's a highly potent combination of both. In the U.S., regulation has been incredibly fragmented and, watered down.
Right.
In 2010, they passed the Durbin Amendment, which attempted to cap debit card fees. But under immense lobbying pressure, they only capped it for large banks, those with over $10 billion in assets.
So small banks got a pass.
Small banks were given an exemption and left totally uncapped. And more importantly, credit cards were completely excluded from the legislation.
Which leaves U.S. credit card fees floating in that completely unregulated 1.5 to 3.5% range.
Exactly. Politicians are terrified of being labeled the ones who, killed credit card points.
Because U.S. consumers genuinely operate under the illusion that their rewards are free money.
Yes. They don't realize they are paying for those points through higher prices on their groceries and gas. And while this political theater plays out, it creates a deeply asymmetrical playing field for businesses.
Right, because an enormous corporation can negotiate, but a local shop can't.
Exactly.
A small local retailer might be paying 2.8% in total fees, while a behemoth like Amazon can use their massive transaction volume to bully the networks into lowering their fee down to maybe 0.9%.
Yep.
They are pumping data through the exact same digital pipes, but the small mom-and-pop shop pays triple the toll. Small businesses are literally subsidizing the payment infrastructure of massive corporations.
It is incredibly asymmetric. But, regulation is ultimately a slow, blunt instrument.
Sure.
It takes years of political battling, and it's usually full of loopholes anyway.
Yeah.
What is much more interesting is that a natural, ruthless market correction is finally brewing.
Yes. This is where it gets genuinely exciting in the source material.
Yeah.
Because merchants are trapped, right? They can't just ask their customers to bring briefcases of cash.
Right, that's not going to work.
But recently, a technical loophole opened up that bypasses the legacy card networks entirely, and it's called account-to-account payments, or A2A.
Yes. And for decades, you have to remember, the only reason cards maintained their monopoly was settlement speed.
The settlement speed, okay.
If a merchant wanted to bypass Visa or MasterCard and do a direct bank transfer, the legacy banking rails took 1 to 3 business days to clear the funds.
And obviously, you can't make a customer wait 3 days at a checkout counter with their groceries while a payment clears.
Exactly. Cards were the only instant settlement option. But that underlying infrastructure has fundamentally changed globally.
The actual rails have been upgraded. Like
Right.
in Europe, they built SEPA Instant, which settles funds directly between bank accounts in under 10 seconds.
Right.
In Brazil, the central bank launched a system called PIX, and it was so frictionless and efficient that it captured 60% of the entire national payments market share in just 3 years.
It was a massive adoption curve.
And now the Federal Reserve is finally rolling out FedNow in the U.S. to do the exact same thing.
Right. This instant infrastructure is the foundation for modern A2A providers like Payware. And because the technological architecture is entirely different, the economics are completely upended.
Okay, walk me through the mechanics of that. Why is A2A fundamentally different from a card swipe?
It all comes down to the difference between a pull payment and a push payment.
Okay.
Credit cards operate on a pull mechanism. When you swipe a card, the merchant is essentially asking the network to reach into your account and pull the funds out.
Right.
Because anyone could theoretically steal a card number and try to pull your funds, the network requires massive, expensive verification systems and fraud premiums to protect the money.
Ah, I see. And A2A is a push payment.
Exactly. With account-to-account, you, the consumer, are securely logging into your own banking environment on your phone.
Okay.
And you are instructing your bank to instantly push the funds directly to the merchant's account.
Which is inherently infinitely more secure. Because there's no issuing bank sitting in the middle demanding a cut to verify a pull. The money just moves straight from vault to vault.
Exactly. It's like building a direct high-speed train from the consumer's bank directly to the merchant's bank, completely bypassing the expensive, decades-old toll roads built by legacy card networks.
Wow.
And the pricing reflects that efficiency. An A2A provider like Payware charges a flat fee of 0.5%. And crucially, there are 0 interchange fees involved.
And they don't have to price in that massive fraud premium we talked about earlier.
Nope.
Because by relying on the secure environment of a smartphone, A2A utilizes strong biometric authentication. Like when you use Face ID or a fingerprint to authorize a push payment, chargebacks drop by 95% compared to traditional card numbers that can be stolen and used online.
It's a huge reduction.
Plus, they aren't spending billions maintaining legacy physical infrastructure, right? Like global ATM networks or plastic card embossing facilities.
Exactly. It is modern, cloud-native infrastructure operating at actual cost-plus margin, rather than monopoly pricing based on market power.
Right.
And for merchants, this leverage couldn't really arrive at a more critical time. Take standard e-commerce.
Okay.
A typical online retailer operates on incredibly thin profit margins, maybe 5 to 15% if they were running a really tight ship.
And if they are paying 2.5% in card fees off the top of their total gross revenue, those fees alone are devouring up to 40% of their actual net profit margin.
It is brutal.
That is just brutal. Plus, physical cards expire. I mean, if you run a modern subscription business, you are losing 1 to 2% of your perfectly happy customers every single month to involuntary churn.
Just because of the plastic.
Just because the physical plastic card in their wallet reached its expiration date and the recurring payment bounced, bank accounts do not have expiration dates, so A2A fixes both the margin crush and the churn problems simultaneously.
Which brings us to the ultimate dilemma for the banks themselves.
Oh, this is fascinating.
Legacy banks are facing an existential strategic crisis right now. Do they stubbornly defend their highly profitable yet shrinking interchange revenues?
Right.
Or do they embrace A2A and actually give the merchants what they want?
Let's run the math on that dilemma.
Okay.
Let's say a traditional bank makes 100,000 euros a year from a specific merchant purely in interchange fees. They want to protect that golden goose, obviously, so they refuse to offer any A2A services to the merchant.
Right. But the merchant is exhausted by these high fees and razor-thin margins. So what do? The merchant simply moves their payment processing to a modern competing bank that does offer A2A.
Right.
The original bank didn't just lose the 100,000 euros in interchange fees. They lost the merchant's entire business banking relationship.
Oh, wow.
They lost the lucrative treasury services, the commercial lending opportunities, the massive corporate deposits.
Everything.
That bank might lose 800,000 euros in total lifetime value just because they stubbornly tried to protect a legacy fee.
So the banks that understand this dynamic, they realize they have to willingly cannibalize their own short-term margins to ensure their long-term survival.
Exactly. Embracing A2A means accepting lower per transaction revenue today, but it fundamentally secures the merchant relationship.
Right.
The modeling shows that a bank that embraces A2A might see their payment revenue take an initial dip, sure, but by retaining loyal merchants and attracting new ones who are desperate for cheaper rails, their total revenue can actually grow by 10% over an 18-month period.
That makes total sense.
We are sitting right at a strategic inflection point.
Yeah.
The critical window for this shift is happening right now, between 2024 and 2026.
Wow.
And the reason this disruption is viable today and wasn't 10 years ago comes entirely down to consumer readiness.
Right.
For A2A to work, the consumer has to be comfortable authorizing a payment directly from their bank on their phone. 10 years ago, the mobile user experience was far too clunky.
But today, the UX barrier is completely gone. I mean, 90% of people have smartphones in their pockets. 70% of people use mobile banking apps on a weekly basis.
Exactly.
We all implicitly trust Face ID or biometric scanners to unlock our digital lives now.
The instant settlement infrastructure is built. The merchants are absolutely desperate for margin relief, and consumers are technologically primed.
It's the perfect storm.
It really is. All the puzzle pieces are finally aligned to make A2A a true existential threat to the legacy card model.
So as we wrap up this deep dive, it's pretty clear the entire foundation of how money moves is shifting.
Oh, absolutely.
I mean, interchange fees might have been entirely justified 50 years ago. Back then, building global, secure digital networks over physical telephone lines was an incredibly expensive, high-risk endeavor.
A huge feat.
But today, the technology has simply outpaced the business model. Instant account-to-account technology is forcing the financial industry to abandon pricing based on monopolistic market power and return to, an honest model of actual cost plus a reasonable margin.
And this shift isn't just going to be some back-office accounting change that only CFOs care about.
Right.
As A2A scales and merchants start saving millions of dollars in payment fees, we're going to see a massive change in consumer behavior directly driven by those merchants.
Exactly. And that leaves us with a really fascinating scenario for you to mull over. We're already seeing data showing that merchants are starting to offer direct, tangible discounts to consumers who actively choose A2A at checkout.
It's already happening.
Yeah. Imagine standing in the grocery store a few years from now. The terminal gives you a clear choice. You can swipe your premium metal credit card and pay the full inflated retail price, earning your standard 2% in abstract airline miles that are locked inside some bank's restrictive travel portal. Or you can securely tap to pay via direct bank transfer, and the merchant instantly knocks 2% off your total grocery bill right there on the spot.
That's a powerful choice.
If you are forced to choose between an immediate real-world cash discount on the food you need to survive or hoarding abstract points for a flight you might take next year, what will you choose? Could this invisible technological shift in banking infrastructure completely kill the modern culture of travel hacking and credit card points?
It's definitely possible.
Something to think about the next time you tap your phone at the register. Thanks for joining us on this deep dive.
That's On the Wire. Produced by Payware, the transaction resolution network for instant A2A payments. This episode was AI generated from Payware's published research and documentation. If something sparked a question, the full source material is available at payware.eu. If you work in payments at a bank, an ISV, or a merchant organization, and what you heard is relevant to what you're building, reach out. The conversation doesn't have to stop here. Subscribe to On the Wire wherever you listen to podcasts. The next episode is already waiting.